Imagine a paradox unfolding in the world's economic stage. Brazil, one of the largest exporters of agricultural and industrial commodities, just recorded the highest December trade surplus in its history. Yet, overall for 2025, its annual trade surplus shrinks compared to the year before. This isn't just numbers on a spreadsheet. It's a dramatic story of global markets shifting, consumer demand changing, and Brazil's role in the world economy being tested in real time. The twist? That December boom hides a bigger structural challenge that might ripple far beyond Brazil's borders. Let's break this down. In December 2025, Brazil posted a huge trade surplus of USD 9.6 billion, the largest ever for that month, driven by surging exports of soybeans, iron ore, coffee, beef, and industrial goods. But when Brazilian officials looked at the full year, the total surplus, about USD 68.3 billion, was almost 8% smaller than 2024's figure. So how can there be both a record month and a weaker year? It all comes down to two powerful forces: imports growing faster than exports throughout the year, and global commodity prices declining. Here's where it gets globally interesting. Brazil's exports still increased in volume, meaning Brazilian products are selling more abroad. But the selling price on the international market dropped, especially for oil and some other commodities. Meanwhile, Brazil's imports rose faster than exports because domestic demand picked up. Brazilians bought more foreign machinery, technology goods, fertilizers, and energy products. In a world where trade balances are a key signal of economic health, this combination, higher imports and lower price-driven export growth, sends a warning sign about how Brazil's economy is integrating into the global system. Now let's zoom out. Brazil is not a small economy. It's a major supplier of food, metals, energy, and manufactured goods to markets from China to Europe and beyond. How Brazil's trade balance changes affects global commodity markets, inflation expectations, and supply chains. For example, China, Brazil's largest trading partner, imported billions of dollars worth of Brazilian products in 2025. Yet global tariff shifts and new trade policies could alter that dynamic in 2026. Changes in Brazil's trade surplus also influence currency valuations, investment flows, and how foreign central banks and investors view emerging markets. This matters for anyone watching global inflation, food security, or industrial supply resilience. A shrinking trade surplus, even in a year with record monthly results, reveals deeper forces at work. It suggests that Brazil's export-driven growth model may be vulnerable when export prices fall and import demand rises. This reflects larger global trends, shifts in commodity prices, trade tensions, and changing consumer behavior as economies recover at different rates after the pandemic era. It also shapes how Brazil negotiates trade agreements, defends its key industries, and positions itself in strategic markets such as renewable energy, agriculture, and tech supply chains. For international investors and policymakers, Brazil's trade performance is a barometer of broader economic shifts. So here's the real takeaway. Brazil's 2025 trade numbers are not just a domestic economic report, they're a window into the future of global trade dynamics. A record December can hide an underlying vulnerability of slower export price growth and rising import dependence. And when such a major economy shows this pattern, it reshapes expectations across continents. If you want a deeper dive into how this may affect currency markets, investment flows, and geopolitical alignments in 2026, hit like and comment Part 2 because this story isn't over.